Very good afternoon, everyone, and welcome to today's uLaw webinar. The topic for today's webinar is Law Society Bookkeeping Compliance. This webinar has been accredited for 1 hour of professionalism CPD credits in the provinces of Ontario, British Columbia, and New Brunswick. So it's for 1 hour of professionalism credits, and of course, we welcome you to utilize this particular title, Law Society Bookkeeping Compliance, and enroll in your individual Law Society portals and claim your 1 hour of professionalism credits. Like always, please to use the chat window. And if you're new to this webinar, you would find a chat window within the Join Me platform we use to ask any questions that you may have at any time during the session. The webinar is being recorded and will be available to you to consume on our YouTube channel as early as Monday. And you are also able to review our previous CPD sessions that have been recorded and be able to take advantage of those as well. Like every other uLaw webinar, today's webinar has, of course, this very specific agenda. And that is to talk about the bookkeeping compliance, the requirements from a Law Society audit or from Law Society in general, and really highlight and keep it crisp to talk about the key documents that you need to have ready and available either when being asked for, when being audited, during a spot audit, if you're just caught by surprise, or if they give you enough time to prepare and have these documents readily available. So we're certainly going to talk about some of the very key important documents that you certainly should prepare and plan for to present or produce when being asked for, and talk about some of the best practices that you could utilize to be proactive in being prepared for this right from day one. And knowing what's being expected allows you to have more clarity about the information that's being asked for. And with regards to the top documents, we first start with the ledgers. This is a certain templatized document that the Law Society requires information in. And for that information to be presented in that report, fundamentally, you should have a way to capture that information, and we'll certainly talk about that and some practices on how best you can capture the information right just in time and being able to translate that information into these templatized reports. So keep in mind two documents, the trust and the general ledger. Now, if you as a firm do not exercise the trust account, of course, you do not need to worry too much about these ledgers. But of course, if you still have a trust account and you don't utilize it, then it's sometimes recommended just to have a zero ledger document available. So it's not mandated. So if you've never used your trust account, that's a different thing. If you don't even have a trust account, that's a different thing. Okay? The general ledger comes out of your business operating account, which everyone should have. And we'll talk about the template information that's being asked for across these two documents. And then come a bunch of documents called the journals, and we categorize them under the receivable and the disperse. The receivable is what we should expect to receive, disperse what's been dispersed or sent. And the slight differentiations between the ledgers and journals. We'll talk about how they differ and the information being different and how they're being captured and being produced across these reports. So now you have ledgers and you have journals. And keep in mind, the journals, the receivables and disbursements are for each of the accounts. So if you have a trust account, an operating account, you have a trust receivable journal, a trust disbursement journal, likewise a general receivable journal, and a general disbursement journal. So there's now 4 documents, and you add the 2 ledgers, now you have 6. And next comes one of the most important documents that you would produce as a legal firm, which is your reconciliation document. There's a lot of importance, of course, that's given towards the trust reconciliation. So if you do have a trust account and you are utilizing it, meaning you're accepting retainers, you're paying out disbursements from your trust account, you're doing trust transfers, then very important document, because the Law Society certainly takes a lot of interest in how you manage trust funds. And there are certain rules and policies that govern how you utilize trust funds, and hence they are very keen to continue to track how best you have used the trust funds within those policies and regulations. So without misappropriating, without randomly transferring money, things of that nature. The reconciliation process is a step where you compare what you have entered or have captured as a legal firm as things have happened, and you compare it with what many call as a source of truth, which is really your financial institution's record keeping. So if you've received a retainer through a check, and typically what happens is you take that retainer and you deposit it into your bank because you want to make sure that that fund is available for you to withdraw or utilize. Now the bank has a certain, or the financial institution, credit unions or otherwise, will have a record keeping of this. In today's day and age, you have this record keeping available for you to consume through the form of online portals where you can log into a financial institution's online site or portal and enter your username password and be able to view or even download these documents. So the reconciliation is where you compare what you have captured. So let's say you have captured that you've received the $2,000 retainer in your own paper-based system or automated system, legal accounting system, and then in reality you have deposited that money into the bank. Then these two pieces of information now match. You've captured 2,000, the bank says 2,000, everything is great. The reconciliation process gets interesting when, like anything else, life happens. You've got that retainer. Either you've entered it into your system but forgot to deposit that check. It was a really fast and furious day and you really didn't have the time, and you left it in your wallet, your purse, your drawer, and you totally forgot about it. In which case, when you reconcile, let's say for that week, or you compare these records for that week or that month, you're going to see the 2,000 show up in your record-keeping system, but there's no trace of that 2,000 in your financial institution system because, hey, you never deposited that check. Now, the Law Society wants you to showcase that. Tell them that, yes, there is a difference, but now be able to validate why that happened. So was it an outstanding deposit? Right? So if that's the case. The other, of course, complete opposite scenario is where you've got the $2,000 retainer, you're really prompt in taking that check to the bank, depositing it, and then you totally forgot about entering it into your own system because you figured, hey, I'll get to that later, and you never did. Of course, the other side of the equation is now imbalanced. When you do your reconciliation, you're going to find that $2,000 has shown up in your bank's information, whereas when you're looking now for your own record keeping, you're like, where did that $2,000 go? You don't find it. It's simpler now because you just go in, enter the information based on the date, and having a receipt or maybe some form of understanding that you did receive it to validate it. Okay? So the reconciliation process is the ability for you to compare and match and ensure that in all likeliness, what you've captured and what's reflected in the financial institution match. And if they don't match, you're able to, through that reconciliation document, provide justification for it. And we'll definitely get into understanding the trust reconciliation. But another major component of reconciliation that we at uLaw continue to talk about is the general reconciliation. Yes, it's definitely not one of those glorified compliance documents compared to trust reconciliation, because the sensitivity around trust is slightly higher. Whereas a general reconciliation document is a great document for your own internal operating efficiency sanity. And I know that's a pretty long English statement, but imagine if you are able to compare, match, and marry each and every piece of financial transaction that has entered and left your operating account. You can be very certain about the revenues that's come in and the expenses that you've expended for that particular time period. And if you subtract the two, you of course get your P&L, your profit and loss for that time period. So generating general reconciliations typically as a part of your best practice pretty much empowers you to have that information readily available, and using that information you can act on it. You can say, where can I be better? Should I be expecting more revenue? Should I reduce my expenses? Things of that nature. Okay? And we'll certainly talk about how tools allow you today, in today's day and context, to help simplify that process. Okay, so now we have ledgers, 4 journals, a reconciliation, so a maximum of 8 documents that you're looking at right now, if you're doing trust and general reconciliation. Then comes an interesting document as part of that compliance checklist or documents that you may be asked for, called a fee book. And we'll talk about that as well. And there's some jurisdictional documents, and at uLaw we've continued to highlight the need to stay on top of the jurisdictional documents, because sometimes the template changes, sometimes they could add new documents that you need to be aware of, so we encourage you to continue to stay on top of these things. But a good example that I always talk about is the Form 9A, which is a document for legal practitioners in Ontario who do trust transfers electronically from a trust account into an operating account. Okay? And at the end of this, knowing, and so that makes it 2 plus 4, 6 plus 2, 8 plus 9, a fee book, and then a few more compliance documents. So anywhere from 9 to 12, 13 documents that you need a plan of action to have readily available for you to produce, or ensure that you have your ducks in a row to showcase it when being asked for. And the question is, how long does this take you today? Are you happy with the process that you're utilizing, the best practices that are governing how you're able to produce these documents? And then certainly talk to you about, not necessarily sell you, but talk to you about the benefits of legal accounting software that was purpose-built to not only produce these documents, but fundamentally allow you to capture this information, which is truly the starting point of this. Okay? So that's the next 45 minutes or so, and hopefully that will be your time well spent. Now we've discussed the requirements, and we'll take a step back, as I mentioned, to talk about how do you plan to capture this information. And if you've participated in some of our webinars, we have this particular slide open, which really talks about the evolution of accounting systems, just a high-level view of it, and talks to you about the ease of use, the benefits, the pros and cons. But essentially, if I were to cut to the chase, in the old school way of doing things, which is really doing this on a paper-based formatting, where you had the typical assets liabilities concept of left and right ledgering, you needed a double entry, a manual double entry system. So if money was deposited here, then money should have been removed from somewhere else, and vice versa. We moved from a manual system then to a one-write system, and then the more commonly available, let me get to that, is the spreadsheet. So a lot of law firms still do use the spreadsheet software if they're doing this in a more semi-manual way. And the evolution moved from there to using some general accounting software that was purpose-built for accounting principles, whether that applies to legal business or other businesses didn't really matter. And then came, or has been the past 10 years and continuing to grow, a lot of purpose-built applications or solutions called the legal accounting software. I should say it's been more than that in some products, but a little twist to that with the modernization is the ability for you to access this information everywhere. So cloud-based legal accounting software, in fact, would kind of be that last line item. But legal accounting software, whether cloud-based or otherwise, was purpose-built to deal with accounting, reporting, legal accounting, capture of information, and having certain policies and regulations that govern the transactional behavior of the numbers within that accounting ecosystem, and giving you those extra, let's call this belts and whistles, checks and balances, however you want to call it, so that they kind of stop you almost from making those bad decisions. They kind of stop you from, let's say, overdrawing on trust accounts. So ensuring that you're doing the right thing of capturing this information at the right time and ensuring that you're very much aware of the governance behind how you manage your numbers. Okay, that's where I think the legal accounting software provides its best bang for your buck as a legal professional. And the beauty of that is it allows you to manage both the trust-related legal accounting data as well as your operating account. So you don't need a separate system for managing your business side of the things and a separate system to manage your legal aspects of the business. Now, within the legal accounting software realm, if you will, there are quite a few options for you to explore, so I humbly request you to use our friendly Google or any search engine that you like and search up legal accounting software and fundamentally go through your individual law society bookkeeping compliance documents. So each province across the country here in Canada has a well-documented PDF that shows you what the expectations are from the law society when it comes to bookkeeping compliance. Okay, and this presentation and legal accounting softwares that are built, including uLaw, which is one, were purpose-built keeping those compliance requirements in mind. Now let's try and dive slightly more deeper into understanding these documents. We spoke about anywhere from 9 to 10, 11 documents, and let's review these documents in slightly more detail. We'll first start with the ledgers. Remember, we spoke about the two ledgers, the trust and the general. And at all times when you look at these expectations, these documents, these templatized reports, always also think about the reality of how and when this data is captured. Okay. From a trust ledger perspective, if I can draw your attention, let me quickly annotate here. If I can draw your attention here, if you can look at the trust ledger, and this is like a little sample that's taken out of the bookkeeping compliance documentation. I think there's a quick question. Legal accounting software is included in uLaw? Yes, uLaw is a legal accounting software. That's correct. In terms of our trust ledger, there are a few data elements, I call them, that are captured in this report. Okay, so you of course have by the specific file. So the first expectation is that you segregate, group, however you want to call it, by the file, because that's the unique aspect to the business. Even if it's the same client having multiple files on them, you have them separated out, because each file's nature is different. So that's the first aspect that you quickly understand. The second is a good understanding and capture of the date when that particular transaction has occurred. That's very critical to the success of all these documents is understanding when that transaction occurred. It can be very crucial, especially from a reconciliation standpoint. So find a way to capture the date. You don't really have to worry about the time. So you can see it's August 31st. I mean, of course, I'll go one step further and put the year as well. But then the particulars, which is really what was this transaction about. Then comes, did you receive money or was money spent out of this account? That's your receipts and disbursements. So you're dispersing money out of the account. And the last, which is the most important, which I find if you're doing this a manual way, often people miss, is a running balance. And the running balance is as you progress between the financial transactions that occur within that matter or file, as on a particular date, how much of trust money is still left in that file's blanket or bucket. Because that information gets captured within your reconciliation, which adds up, which is otherwise called as the trust listing, which shows you all the outstanding balances against each file and customer that adds up your trust balance. So if you have $5,000 sitting in your trust account, that is an accumulation of all the retainers or money that you've received into the trust account, right? And you need to be able to show who are all those clients who have contributed to that money being left in the trust balance. And hence, a running balance is very critical, because you could have a trust account that spans multiple months, and when you reconcile, let's say for the month of August, you're capturing the running balance as part of that trust listing. And that's why a running balance is very critical, especially when you are dealing with trust money. So that's essentially what it is. This is the kind of data capture that's required. This is the template that is required in, and depending on the quantity of information and transactions and files that you and your firm manages, you now have to take a good stand of how you want to help yourself reduce the amount of manual work that you put in to create this. Okay? Now, money coming in, of course, can be for various different factors, so I don't want to go into this. So retainer is one example. You could have a real estate money coming in for real estate transactions. So there could be various different reasons why you have money coming in, right? So we're not going to focus on that, but what we want to focus on is that money entering an account, money leaving an account needs to be accounted for. So trust is one account. General or operating is a separate account. Of course, you could have multiple trust accounts, multiple general accounts, and if you do have that, then you certainly have to do the same set of procedures and processes and documents for each of those accounts. Okay. Now we move to the image on the right, which talks about the general ledger. And you can see there's some similarities here. You have the date, the particulars, and instead of just a blanket called receipts and disbursements, now they're kind of stretching it out to just capture a little bit more. So you have expenses, similar to disbursements. Now in the expenses, it's interesting in the operating account, there are two different types of expenses that you may end up capturing. One, expenses that are paid on behalf of client, which are disbursements. And then the other could be expenses that you pay on behalf of your business's requirements. Whether you're purchasing a laptop and you're using our operating account to pay for it, because it's a business expense. You're paying for rent, you're paying for internet, whatever it may be. All those expenses get captured as well. Of course, in the first example, the line item should clearly state the name and file of the client for whom that expense was disbursed, whereas in the second example, it would be a business or corporate expense that you capture. So in the particulars, you would identify the nature of that expense. Whereas in the trust account, of course, it's frowned upon and it's really not allowed for you to pay for office expenses from your trust account, because your trust account is pure in its sense that it's utilized for client and client-related activities only. Okay? Now, when it comes to capturing revenue or receipts here, there's another subdivision of that revenue that you've captured within the general ledger, and that is the fees before and after taxes, depending on your provincial, wherever you're operating. Of course, we've taken this excerpt from the Ontario Bookkeeping Compliance, which is the HST, but you may have your GST, PST added to this as well. But it's important within the general ledger that you have room to capture this as a column which divides the revenue or the receipt of the money coming into that between the before tax and after tax. And the reason for that is, of course, to calculate taxes. And if you do have a HST account, GST, PST account, this taxes that you've now collected would need to be balanced out with the taxes that you've paid to manage your business, and the difference would end up either for you to pay the government back, right, or you have to pay for your taxes, and this is not income tax, right, this is the jurisdictional taxes that you've captured, and or sometimes you may receive or money back from the government because you've spent more HST than you received. And if you don't have your tax account, and if you're not capturing taxes, then clearly this particular column would say 0. So in this example, this would be 100, 0, and then the balance owing would be 100. So clearly showcasing that you're not capturing. Okay. So now you need a system that allows you to generate these types of documents, but also capture and give you the flexibility of capturing revenue with tax, without tax. You may have some files with tax, some files without, some files it's included, etc. Right? There's different flavors to how you may be retaining that customer. So we've kind of gone through the ledgers, and hopefully you understand the differences and what's expected in terms of the reporting when it comes to ledgers, trust and general. Now we move on to the journals, and we've spoken about the 4 documents: the trust receipt journal and the trust disbursement journal, likewise the general receipt journal, the general disbursements journal. Okay. Now you can see there are certain similarities to the ledger. For example, the date and the purpose of funds, similar to maybe the particulars of a ledger. But you see some additional data elements being captured, which was not there in the ledger. And this was, who does this money come from? Who paid for it? Whereas here you don't see who paid for it. So the journal captures the source of the fund. Of course, it captures, and I'm talking about the trust receipt, so money received into the trust account on the 5th of July. It was for a retainer of $565. This is very similar information to the ledger. The 2 additional pieces of information was who paid for it. And this could have been the client themselves, it could have been someone else. And the last one is the actual method of payment. So how did they pay you? The journal is a great document that is going to help you during a reconciliation, especially if you're dealing with a lot of checks, so that you can fall back to the journal if you've captured it right to give you that source of information about where you should go look out if you've lost a check, for example. Once you open the journal and it says check 3245, then you have some relevance to go back to. So the 2 differences is who was the money received from and what was the method that they used to pay. Of course, this example talks about checks, but today's day and age, you have various different ways of payments that you could receive. Electronic funds you can even receive through credit card payments, where credit card funds are directly deposited into the trust account, and any fees that that credit card may charge you is now taken out of your operating account, leaving your trust account untouched, right? So that's critical from a trust receipt journal. Now, if you look at the trust disbursement journal, where you are now paying out of the trust account, you're dispersing out of it. there could be many reasons why money is leaving the trust account, right? One is you could be doing a trust transfer where your money is leaving the trust account and entering the general account. So you need to have an audit trail of that. Or another thing we advocate for is utilizing the trust account wisely to pay for disbursements, because these are dollars or monies that were never really part of your revenue to begin with. If you're paying for an application fee, court fee, these are just expenses that you have to deal with, rather paid out of trust accounts so that you don't have to deal with recovering it, in a sense. So keep in mind when we're looking at the trust disbursement journal, it's the same date. We want to understand the method, which is similar to the method in the receipt. Now the question is, like how we had received from, we have this paid to. So who was this paid to? If you're doing a trust transfer, and if this is between your own business, then it's your name that goes on it. If this was a disbursement, trust disbursement, then this would be court fee or application fee, or it could be the Ministry of Attorney General, it could be Ministry of Finance, whoever you wrote that check out to. Then comes the purpose. This is purpose of funds received, this is purpose of payment. You can see it's just mixed up, but it's very similar in nature between the trust receipt journal and the trust disbursement journal. It's got the same 5 columns. So what was the reason for you paying out of the trust account, and how much was the amount? Okay? And the audit trail is really simple when they look at these 4 documents together. So on July 5th, you received the retainer through a check of $565. And on July 14th, you wrote yourself a check. 001 was the check number to yourself, and that was through an invoice that you had generated, because that's critical. For you to do the trust transfer, you do need the invoice to validate against. And there was an invoice that you generated called 002, and then you moved that money from the trust account into the general account. And if they move into the general receipts journal, which is I've received money into the general account, you're going to see on July 14th there was a transfer that was done regarding the Piper invoice of 002 of $565, and the trust check, as we all know, is 001, and there it is. So the auditors will be like, okay, that's a fantastic capture of audit trail, because that was the intent of these documents to begin with. Okay? So we move into the general receipts journal now, and just that example, it's 4 columns now instead of the 5th. The date, really standard across all. Who was it received from? In this case, it was received from Leslie Lawyer. It was the amount. What was the method? Okay, you can see the journals are big about method. How did this get paid? And that's for traceability, really, not beyond anything else. That's just meant for traceability and help you too. Now, the general disbursements journal, very similar to your general ledger, encompasses a little more details. The date is a constant. The method is a constant across all journals. Disbursements is where it's money leaving the general account, and hence, who have you paid this to? Why did this money leave? Who was it paid to? So you could have your office supplies, as I mentioned earlier. You could have your landlord for your rent. This could have also been disbursements paid on behalf of clients, in which case this would be a method and paid to Ministry of Finance. And the particulars would have been court fee or application fee. Now, this general, both disbursement and ledger are very big on taxes. You can see in the trust, they're not big on taxes. Whereas in the general is where they want to clearly demarcate between before and after tax. Hence, you have the amount before tax, the actual HST paid, because in this case, this is a disbursement, there's money leaving. So now you've captured the amount of money that you've paid. So now you're going to capture HST paid, capture HST received, and now we utilize those two pieces of information to give you a number whether you owe the government or the government owes you. Okay? So there's really a method to the madness. There's a reason behind why they're asking you for this information and how it's being captured. As long as you can acknowledge the reasoning and the actual requirement, then it will be easier for you to reconcile internally as to how you produce it. Once you have that appreciation, then you can approach how to solve the problem faster. You know how to solve the problem. It's a question whether you want to do mental math, abacus, use a calculator, or use a third-party accountant to help you do that math. Okay? Okay, so we've looked at the 2 trust documents. We've looked at the 4 journal documents. And please do use the chat window if you have any questions with regards to whatever we've discussed so far or whatever I've been talking about monologuing here for the past half hour. As I continue to move along into the reconciliation report. It's a big word. It's a scary term. Everyone's really talking about it, eh? And as I mentioned before, the reconciliation, I'm not going to go back into really talking about what it is, but it's certainly an accounting procedure that every business does. What's unique to the legal business is that you do have this trust reconciliation and, of course, the sensitivity around it, the focus, the limelight in producing the document. But every business does reconciliation. Small shops reconcile on a daily basis, right? How much money did I get in today? How much money did I pay out? They capture it even using their cash register. Walmart does it every day. Every business does reconciliation on a daily basis. It's an accounting procedure to ensure that you have full control and access and information about the transactions that have entered and left. Okay. When it comes to reconciliation of the trust account, again, the method to the madness, a certain template, because they want you to highlight certain pieces of information. Auditors don't have all day long, they don't have, multiple weeks to spend going through your each and every transaction. A fast, easy way for them to understand if there's any challenges or pain is by reviewing these documents, and that would pretty much trigger an alarm if they see something off, right? For example, if you don't have in your reconciliation trust balance, then you're going to be asked to produce that. Things of that nature. Or if you don't have validation for why the numbers are off, then you're going to be asked that. And it's best if you have the answers ready proactively rather than reacting to it after the audit. So the reconciliation of the trust and the report consists of, we've divided this rather at uLaw into 4 main sections. Okay? First is, of course, and when I say we've divided this, we've taken it out of the bookkeeping compliance, but just try to simplify it for you to keep in mind. It has the recording of your financial statements or your financial institution statements and balances. As I said, let's consider that being the source of truth, the financial institution. Okay? So the bank knows money coming in and leaving the trust account. That's their side of the house. Let's keep that aside. We want to understand what the balance is as of the particular date, and that's very important. So when are you reconciling? Are you reconciling of August 10th? Are you reconciling August 1st, or is this the previous month? It's important to understand which date you're reconciling on, because it then captures all the data that's happened until then, including that date. And that's the date. So as of July, let's say 31st, what is the bank balance in your, TD, RBC, CIBC account? The second is the recording of outstanding checks and deposits. This is as I said, this could be where life happens. Okay, these are the anomalies. If each and every transaction matched one after the other, then it's a really fine, happy day. these are the exceptions that we're capturing in Section 2. So outstanding checks, outstanding deposits, money that have not cleared, you paid someone, but they've not deposited it, or someone's paid you and you haven't deposited. Either money has not left because someone else didn't do their job, or money has not reflected into your account because you didn't do the job in time. You may have delivered this check after July 31st and it got reflected in the bank a later time, but at that particular time maybe you didn't do it. Or you still have it in your drawer, wallet, purse. That's what this procedure is looking to capture. Not looking to necessarily catch you on the wrong foot, but certainly capture what happened so that you can reconcile with that. Okay, so outstanding deposit checks, and then some of the things we've seen quite often but are reducing now with the Canadian banks or financial institutions appreciating the legal business and the sensitivity around trust is the bank error. Typically, we've seen where financial institutions in the past may take away bank fees out of your trust account, and then you have to call them and then tell them that, hey, please take that bank fee out of my general account. But often these days, as you start the bank account, we start finding many of our new practitioners who work with us don't have this problem, which is a good sign. But if you do have that problem, if the bank fees or any other fees have been taken out of the trust account, we encourage you to continue to review your bank statement at least on a weekly basis, if not daily, and then capture these problems before you reconcile. Because one thing is, if you're doing this on a weekly basis, whether it's outstanding deposits or checks or even these bank errors, you're catching or capturing these aspects of anomalies early enough to make corrective measures on it. For example, if you are capturing this on a weekly basis and you find that on the first week of August, you find this problem of a bank fee being withdrawn from your trust account, rather than waiting till the end of the August month, okay? So if you were to do that on the first week, you can right away call the bank, ask them to take the money or deposit that $6, $10 back into your trust account and take the money out of your general, which means it's pretty much balanced. Almost seems like nothing really happened, right? So if there's minus 10 and 10, it kind of balances it up to 0. You don't even have to reflect the bank error. But if you're doing it at the end of the month and it's a bit too late, because let's say you're doing it on the 30th of August, or the 31st, yeah, and then it's too late, the bank is not going to reflect it, then you have to report it as a bank error. Okay, so stay on top of your numbers as often as possible and be able to be proactive in capturing any mistakes that they may have happened. And the third most important component of a trust ledger or reconciliation report, rather, is what we mentioned before, the client trust listing. And this is very critical, and often we find if you're doing this on a manual basis, this is one section we find most of folks have problems with because they never planned for this. But this is one area, again, a legal accounting system really helps you because it's continuing to do the work for you. As you enter a retainer, as money is being withdrawn out of trust, that system, the legal accounting system, continues to capture the balances. Not only that, I mean, accounting systems would do that, but let's say you had $2,000 in your trust account profile, you received it as a retainer, now you're looking to transfer $2,500 out of the trust account into your operating account, right? Ideally, it should not be the case. You only have $2,000 in the trust account. So a legal accounting software has those little checks and balances that says, I'm sorry, you cannot withdraw, $2,500 unless you've deposited another $500 worth of retainer that we don't know about. If that's the case, perfect. Please enter that $500 retainer. Now you would have enough funds to transfer the $2,500 over, right? Simple things like that that can help the quality of data that's coming in. So, because data in is data out. So if you've done well enough to capture the information in a very qualitative, filtered manner through using checks and balances, then you can be rest assured and have a, leap of faith, for lack of a better term, about the quality of the data out. which is the report that you're showing. And what is captured in this client's trust listing? In fact, sometimes auditors may even ask you for these trust balances or trust listing, however you want to call it, as a separate document, okay, which captures three pieces of information: the name of the client, the last activity date, which is really when was something ever happened in that file last. And this is critical because if you've had retainer money or trust money sitting against a client's file for a long period of time, let's say you've had it for 10 years, again, there are certain governing policies and regulations around how long you can hold that fund. Right? And the recommended procedure after a certain time for you to do is to refund that retainer. And of course, send them a closure letter or a non-engagement letter, whichever is more meaningful. So 3 pieces of information, and they accumulate. The 4th piece of information is the total summary of all your clients. So Peter Piper having $1,120, Silver Susan having $72, and then Taylor Terry of $523 is great, but it's important that you capture the total balance because that should match with your reconciled mixed trust bank balance. So what you have in your financial balance as of that date is nothing but a summary of all the trust listing balances against all of your clients. And that's what the 4th says. This is what the bank balance is, and this is what and again, legal lingo, but this is your trust bank balance, financial institutions record keeping, and unexpended balances, these are the balances in my client's trust that I have not yet expended. Okay? That's the 4 important pieces of information that needs to be reflected across a reconciliation report, a trust reconciliation report. So 2 ledgers, 4 journals, trust reconciliation report. Now, I know I don't have the slide, but in a general reconciliation report, you have 3 steps. The only step that's missing, and it's really not valid, is the step 3, which is the client trust listing. In a general reconciliation report, you don't have a need for a trust listing, and hence you just have the initial bank statement balance, outstanding deposit checks, because it could happen, right? You may have got a payment from your client through a check, and the same thing could have happened where you did not deposit that. Or you may have written a general check to pay, I don't know, your landlord, and for whatever reason, the landlord has not deposited that money, because till she or he deposits that money, it's not going to come out of your bank account. So both things happen, so outstanding deposits and checks can happen in general accounts as well. And the 3rd is just the comparative statement between your general bank balance and your general, your general ledger. So instead of 4 steps, the general reconciliation has 3 steps. Okay, so we looked at 2 ledgers, 4 journals, 2 reconciliation. If I do the math right, that's 8 documents. We now move into the fee book. As the term sounds, it's really capturing all the fees that you have received, and mostly from clients, right? So it's really a record keeping of all the invoices, and especially any disbursements included, very importantly, in that invoice, because it's important for you to recover that. So fee book not only captures the fees, so your legal fees, whether it's a flat rate, whether it's time and material, but it's also capturing within that invoice element your disbursements, if any, that you've dispersed, that you're generating as part of the invoice. The fee book also records, and I'm just reading this because there's no other way to explain it, the invoice number. And this is why it's important that you have a system that can help automate unique invoice numbers. If you're doing this manual, and we've helped many customers move from manual to automated. One thing we found was sometimes we make mistakes, manual mistakes, human error. And if you're generating invoice numbers manually, you may unfortunately end up putting a 2021 August number 3 twice. That happens. And hence it's important that you have a system that allows you to generate these invoices uniquely, so that's not another item to keep a tab on. What does the fee book include? The actual date, and that's a standard across all documents. An invoice number, so what is the context of this fee? So the invoice number really captures the essence of what's in a particular invoice. Who is it for? So the client's information. Now you divide the total fees, the total disbursements, and any provincial taxes that you have charged. Okay? And the total. So that's what's in a fee book, document number 9. Okay. We'll definitely take a look at some of these templates, time permitting. Certainly have another 6 minutes left or 7 minutes left. Some other compliance documentation. Form 9A is one of the most, I've started to see auditors asking for this document more often today because of the post-COVID, we're in this electronic way of doing things. So if you're doing electronic movement of money from trust to general, there's this template called Form 9A, which captures the from and to institution's name and address, the purpose for the transfer, the amounts transferred, and you physically having to sign the document vouching for that you've done it, and this is the reason for it. That's pretty much what the Form 9A is. Cash deposits need receipt and deposit slip. So let's assume whether that's trust or general. So for trust, I believe it's up to $7,500 worth of cash of retainer that you can receive. Or you may have payments being received for your general in cash. So there's no other method of traceability, right? And hence the Law Society requires you to, 1, produce a receipt that says, thank you, customer, for paying me the $3,000. Here is a trust receipt, or here is a payment receipt for the $3,000. Confirming or conforming that you have received that money in cash. And the next is you take that cash and now you deposit that into your account, into the bank. So you're going to meet a teller or you're going to go into an ATM machine to do that. Get that deposit slip or the receipt of that payment done through the ATM machine. That's very critical, especially if you're dealing with cash. That's part of your compliance documentation. So finding the receipts, just make it a part of the process. Anytime you receive funds, trust or general, produce a receipt. Almost like a thank you note. And there's a certain template for these receipts, which captures the client, the information, the file, the purpose, the amount, taxes, etc. Okay? So now you have about 9 plus at least 2 that we've discussed, Form 9A and, receipt, that's 11, and then deposit slip 12. So about 12 documents at a kind of minimum basis that you're now having to deal with. Now you're having to deal this with on a regular period of time. You generate these on a monthly basis. Of course, the top documents that people generate, the number 1 would be a reconciliation, because you have to do and verify and validate a manual process. Once you've reconciled it, all the documents, the numbers are written in stone to some extent, and now you're able to generate these documents with confidence. Okay? Now comes the final question of how are you doing this today? Knowing that these are 12 documents, or if you're not doing this yet, how do you plan to do it? What is your plan of action? If you only have 1 transaction a month, perfect. Maybe you really don't need a system. You have a manual process to do this, and you're happy till the volume grows. But when the volume does grow, how do you prepare for it? And that's where, as I mentioned earlier, automation and software that were purpose-built to help you through this can help reduce the time and effort that you have to put in to generate these documents. Okay? Because as part of the benefit, and I cannot stress this more important than the reporting capability is the ability for you to capture this information in a timely manner with those checks and balances, right? So that you're really having a good quality of data coming in. Okay? Because sometimes certain systems can allow you to overdraw on trust, and that is not beneficial to you at the end of the reconciliation term period. Because what is the point if you only got $2,000 as retainer, but you're being able to transfer over $2,500? How do you go and warrant that additional $500 now that you've withdrawn? Where would you put that number against? That's where people make mistakes, and that's what the Law Society is looking to catch. That's a good question. So FeeBook, yes, would certainly give you a good summary of pre-tax dollars, and that's one certain document that you can certainly look at understanding what your actual revenue is. Absolutely, yes. So I'm going to now quickly jump gears. I think the question was, how do I generate it? So what I have here is the uLaw system. I'm logged in using a fictitious practitioner, Roger Moore. I'm going to dive right into the accounting section or the accounts section, which is pretty much where all the action happens. And we have a separate button called compliance, which gives you the combination of both monthly and the yearly end compliance. And within the monthly, you could see pretty much all of those requirements are captured in these sections, starting with your Form 9As. If I can generate that real quick, you can generate this for a time period. As long as the data is in, the system is able to report it, right? And here are all of your Form 9As. You don't even have to manage them. You can just print them, sign them, and have them ready. It captures the name of the financial, the from, and the to, and who was it for, the details, and all of that. The reconciliation, and this is really what the money pretty much captures all of the transactions that have not been reconciled. So you can see there's 1,130 of a retainer that was received, but the only thing. So open up your financial institution, enter the balance, and you should be able to generate your preview. We have what's something called as a preview, so you can review it on a daily basis and then generate one reconciliation document at the end of the month. Because the Law Society still believes, generating a report on an actual physical document on a monthly basis, but you can continue to monitor it on a daily, weekly basis with the uLaw system. That's how we want to ensure that you're staying on top of your numbers, right? General reconciliation is the same. Probably going to have more transactions here. There you go. You have your $15.95, and you can see even the nomenclature is more simplified. It's withdrawals and deposits. Once you've done that, your trust ledger for this month, it's just a click of a button. Wrong document. So here's a preview of your reconciliation report, giving you your closing balance, financial balance, all the transactions that are cleared, and now your trust listing. Of course, this is a fake database, or a demo database rather, and tells you the comparison between the two. Okay. So yeah, generating documents after that is just a matter of clicking the button and generating it. And the question on the fee book, absolutely yes. So for the end of the year, you want to quickly review your revenue pre and post-tax. This is one simple, great document. There you go. Right at the end, you do have a pre-tax, tax, post-tax revenue. And if you're capturing taxes, then of course comes down to, and the intermatter trust transfer is another document that they may sometimes ask you for. Journals, we discussed that. So general disbursement. As I mentioned before, within a legal accounting software such as uLaw, the convenience is that we're able to capture the information in a timely manner, and then we're able to contain that information readily available to be reported based on your need. If you're going to need your tax information, here it is. If you're going to need so this is essentially your disbursement journal, general, and you can see the various checks. One was a disbursement for the file, but another one was just staples for purchase of a computer. So I guess we're on pretty much top of the hour. I didn't even imagine it was that fast, but if you have any questions, please feel free to send it via chat. But I want you to just take away, regardless of the uLaw system, legal accounting, those 9 to 10 documents that you certainly need to be aware of. If you're already doing this, that's fantastic. Just now find faster, effective ways that you can generate these documents. And if you're not in the market for a system yet, then you probably should, depending on the volume of your business. And if you are in the market, do search up the legal accounting software space first before you make your decisions, or do make it a big part of that checklist of systems that you are looking to explore when you're looking for a system. Okay, so with that, I'll wrap this webinar and wait for any questions that you may have. The top question I've already asked or been asked is the HST document. So within the uLaw system, you do have a separate place for HST, GST, and PST separately, because we do serve all provinces across the country and their legal accounting needs. And a click of a button, we pretty much tell you the HST you've paid, the HST you received over a term period, and how much you owe the government. Or if this map was different, it would say returns, if the government owes you money. So based on your cycle of when you need to file returns, you can pretty much utilize this report to tell you how much of money you owe the government. And here's the expense book, which tells you all the expenses that you've incurred, both for your office as well as for clients. So this is a general disbursement report. Again, you can see if it's a disbursement, the client and the description pretty much talks about what it was for. But if it's a corporate expense, you can say this was a injury. What's a good expense? These are random information. Oh, here it is, purchase of a computer. Okay. So I'll wait for any questions that you may have. Maybe another couple of minutes. If not, I guess I'll thank you for joining me and my team for today's webinar. Again, the topic for today's webinar, and you can see this on our website at info.uLawPractice.com/webinars, was the Law Society Bookkeeping Compliance. And you don't have to worry about the 10 minutes or 3 hours. The title is Law Society Bookkeeping Compliance. Accredited for 1 hour of professionalism CPD credits in the provinces of Ontario, British Columbia, and New Brunswick. If there aren't any more questions, thank you very much for your time. It's being recorded, will be available to you, and we thank you for participating and joining. Have yourself a fantastic weekend ahead.